Hi everybody, this is Thomas from Wynn Capital, and here's the market summary for the third quarter. All of my contact info is on this first slide, and I'm going to go through quickly. But if you want to pause, just pause any slide if you want to take a longer look, and connect with me anytime if you have questions. So here we are with the summary slide that shows the quarter returns for the U.S. market, international developed, emerging markets, global, real estate, and the bond market. U.S. was up big in the quarter, and the rest of the classes or asset classes were flat or slightly up, slightly down. This bottom section is helpful to give context about any particular return. The U.S. market, for example, is up 7%. The average quarterly return is 2%. The best quarter ever is 16, and it tells you when that happened. And the worst quarter was down 22% or 23%. So if you look across this, you could see from the volatility, the highest to the lowest, gives you some insight into what's risky and what's not. Emerging markets, which is having a tough time lately relative to US, can have great quarters, and that's why we have it in our portfolios. Can also have bad quarters. And we have globally diversified, so we own all of these asset classes. And you can see that bonds are the less risky with a very, very low volatility. The biggest quarter and the lowest quarter is pretty tame. So if we go to the next, this is just the quarter in a graph with the news items that were coincident with the movement of the market. And everyone, you should know by now that we don't believe that there's anything to be gained by trying to predict on news that's going to come out how the market's going to predict it. People have been trying that forever, and there's massive data that shows that you can't really guess, for instance, that interest rates are going to go up so the market's going to go down, or anything like that. In the short term, the market is very, very unpredictable. But that's the news. This is just a bigger look. This goes back a full year on the larger picture with the news, and then and even in the inset is an even longer term picture of the path of the market. So this is a very world asset classes. The U.S. was the best performing in the quarter, and then you'll see that there was the emerging markets very diverging, not even down 4% versus 7% for the best performing. If you concentrate on the U.S. stocks, you'll see a theme this quarter that growth stocks are winning at the moment, and small value is underperforming relative to that. Now, we typically overweight small value because over long periods of time, it does outperform by about 4% per year. But we can't know what year that happens. It's very, very irregular. And so we stay the course when growth is in favor, and we're there when small value does its inevitable outperformance. Here again is international instead of just the US. These are the developed foreign countries, and again, growth is outperforming small in that picture as well. And then if we zoom in on emerging markets, value actually was the best performing, but in general, everything was down, and emerging markets are going through their periodic underperformance. They have long periods as well as outperformance. And again, that's why we own it. We don't know each day or week or month or year when it's going to outperform, but we own it because over a long period, it has higher returns. And then the country chart for the developed countries over on the left side and the emerging markets on the right side, you can see it's about half and half with huge divergence between the winners, US and Israel, the winners in the developed world, Ireland, and these other countries, big losers. Same thing on the emerging markets, except even more volatile, 15% on the top country, minus 20% on the lowest country. And you can see from the news of the day, kind of figure out what's causing the rising, what's causing the rise in some markets and the fall in other markets. Here's commodities, and again, just a few of the commodities are up and most of the commodities were down. This is counterintuitive, as a booming economy, which we have in the US, should imply higher prices for commodities, the things that people need to build things. But commodities have been going through a long bear market, which is extremely counterintuitive. How do things get cheaper as the population and the economies grow? But in general, the global economy is not growing very fast. The US has had some fast growth, but other economies globally are not, which leads us to believe there might be a even further slowing. Although if you tried to time the market based on commodity prices, you would have been wrong for a long time. Prices have been rising, but commodities going down for 5 years, actually even over a 10-year period. And we have a small position in gold. When gold prices go down, we buy the gold miners. We get as high as a 2% position. We have a relatively small position at the moment, but it's getting to the point where we're increasing our holdings in gold. And we'll see. In the past, it's worked out well. We'll see how it goes in the future. So fixed income, the long bond took a big hit as real interest rates went up. The Fed has been raising interest rates for almost 3 years, and they're approaching their target. And normally, over that time, real world interest rates like our mortgages don't rise and fall with the Fed. Last year, the long bond was up 9%. The Fed was raising rates. This year, the Fed's raising rates and they're down. So trying to guess and time that just isn't, it doesn't correlate. So that's why we don't do it. We still have an allocation to long, intermediate, and short-term bonds, as we always have. We overweight a little bit based on many factors, usually not the Fed, but at the moment, long bonds are down. Now, over the long term, we own long bonds because the rate of return over the long term is better than the short-term bonds. This is DFA's editorial, and it's talking about the performance. Does performance correlate to the cost of your portfolio? And so they have portfolios here, the expense ratios of portfolios from high, and you might think that a 1.93. Now, this isn't the advisor fee. That's the fee the mutual fund charges investors. And there are many funds that are this high, and their performance likewise is very poor. And medium funds, and this is considered a low and medium low and a very low. Now remember that our portfolios have a 0.23%. It's a cornerstone of how we invest, is that we have much, much lower expenses. Many of these funds do the exact same thing. Inside of each of them is a US large cap, but you could buy a US large cap that has a 2% expense ratio, etc., all the way down to our large cap, costs 23 basis points. So they didn't extrapolate what the performance was, but you could pretty much guess that investor returns are usually, if you have a diversified portfolio and you invest in a proper way, your performance is going to be the benchmark minus your expenses. And so it's very, very, the highest correlating factor is the cost of investing. So this goes on for several pages, and I hope you read it. They're usually very, very helpful, and these are well-researched papers. Again, here's my contact info. I hope that you find the information helpful, and you're welcome to give me a call anytime if you have questions. Thanks a lot, and I'll talk to you all soon. Bye-bye.